9 people sit in a room in Tokyo. You have never heard their names. You did not vote for them. They do not answer to you. But last week, one of them said something that moved global currency markets within minutes. Not the Federal Reserve, not Wall Street, not the White House. 9 Japanese bureaucrats. And the decision they're about to make could crash your stock market, spike your mortgage rate, and trigger the largest financial unwind in a generation. Here's why Tokyo is the most important city in global finance right now, and why almost nobody is talking about it. To understand Japan's power over the global economy, you need to understand one mechanism. It is called the Yin Carry Trade, and it has been the hidden engine of global markets for over 2 decades. Here's how it works. For most of the last 25 years, Japan kept its interest rates at essentially zero, the cheapest borrowing environment in modern financial history. Investors could borrow unlimited yen at near zero cost, convert it into dollars, and invest in American assets earning 5, 6, or 7% annually. The profit was the gap between what they borrowed and what they earned. Free money, and the world took as much as it could carry. Today, in early 2026, that gap is collapsing. Japan is raising rates for the first time in nearly 20 years. And sitting on top of that collapsing gap is roughly $2 trillion in investments that depend on Japan keeping borrowing cheap. Bank for International Settlements, 2025, that is the scale of what happens when Japan changes its policy by even a fraction of a percent. But here is what makes Japan's situation genuinely dangerous. Japan does not just control the borrowing costs of global hedge funds. Japan controls the borrowing costs of the United States government itself. And right now, for the first time in decades, Japan has a reason to stop helping. As of January 2026, Japan holds $1.225 trillion in U.S. Treasury bonds. U.S. Treasury Department, 2026, not China, not Saudi Arabia, not the United Kingdom, Japan, the single largest foreign creditor of the United States on Earth. When Japan reduces its treasury holdings, U.S. bond prices fall and yields rise immediately. Rising yields mean rising mortgage rates, rising business borrowing costs. The entire American credit market reprices upward, not because the Federal Reserve made a single decision, because Tokyo did. This is not theoretical. In 2026, Japanese government bonds are offering higher yields than currency-hedged U.S. treasuries for the first time in decades. When Japanese bonds pay more than American ones, Japanese institutions stop buying American debt. They bring the money home. And when $1.225 trillion starts moving, even slowly, U.S. borrowing costs follow immediately. Japan carries a debt-to-GDP ratio of 237%. The highest of any developed nation on Earth. IMF 2026 at zero interest rates, that debt was manageable. But Japan is no longer at zero. The Bank of Japan has raised its policy rate to 0.75%, the highest level since 2007. Bank of Japan, March 2026, that still sounds low. But on a debt pile of 1 yen and 15 sun quadrillion, even a fraction of a percent adds trillions in annual interest costs. Servicing that debt now costs more than 31 trillion yen per year, the 6th consecutive record high. Japanese Ministry of Finance, 2026. Here is the trap Japan cannot escape. Raise rates to control inflation, and the interest bill becomes unsustainable. Keep rates low, and inflation keeps burning. The yen keeps weakening, and the carry trade keeps building. Every policy decision the Bank of Japan makes sends shockwaves through global markets the moment it is announced. There is no clean exit, only a choice between different kinds of damage. In February 2026, Prime Minister Sanae Takaichi wins the Japanese election with a landslide majority, 2/3 of the lower house, a mandate for massive government investment in technology, semiconductors, and defense. The fiscal 2026 budget exceeds 120 trillion yen for the first time in Japanese history. Defense spending alone hits 2% of GDP, 2 years ahead of schedule. Japanese Ministry of Finance, 2026. More spending means more bond issuance. More bond issuance means faster carry trade unwind. But here is the political collision that is genuinely dangerous. Takaichi needs cheap borrowing to fund her record spending, which puts her in direct conflict with the Bank of Japan's inflation-fighting mandate. After her election victory, she openly told the BOJ governor she does not want rates to rise further. You now have a prime minister demanding low rates on one side, a central bank signaling continued hikes on the other, and a $2 trillion derivatives market watching every word spoken between them, ready to move violently the moment the messaging breaks down. But none of this captures the variable that nobody planned for, the one accelerating Japan's entire timeline faster than any central bank model predicted. It is not a financial variable. It is a war, and its transmission mechanism runs entirely through Tokyo. Japan imports approximately 95% of its oil from the Middle East. Japanese Ministry of Economy, 2025, when the United States and Israel struck Iran on February 28, 2026, the immediate headlines focused on the military operation. The financial markets focused on something else entirely. Oil prices surged. For Japan, that means higher import costs, higher inflation, and more pressure on the Bank of Japan to raise rates faster than planned. Japan's 10-year bond yield has already risen above 2.3% in March 2026, marching toward multi-decade highs. Bank of Japan, March 2026. A war in the Middle East is now a direct input into global financial stability. In August 2024, the Bank of Japan raised rates unexpectedly. A single decision, a single morning in Tokyo. The Nikkei fell over 12% in one trading session. The S&P 500 corrected 6% in the days that followed. Bloomberg, August 2024, global markets lost trillions because of one decision made by 9 people in a building most investors could not find on a map. That was a warning shot. The carry trade was smaller then. The positions are significantly larger now. Major research houses have called this a ticking time bomb, a collapse on the scale of 2008, of 2015, of 2020. Goldman Sachs Research, 2025. The difference this time is the scale. The bomb is bigger. The fuse is shorter. When a yen carry trade unwinds, the damage does not stay in Japan. It creates a liquidity vacuum in New York, London, and Hong Kong at the same time. Hedge funds that borrowed yen to buy American assets suddenly need to repay those loans. They sell American assets first. Stocks fall. Bond yields rise. The dollar weakens against the yen. All of it triggered by a decision made in Tokyo. The US dollar to Japanese yen exchange rate has become as important a leading indicator as the Federal Reserve's own policy statements. JP Morgan Research, 2026. The exchange rate between two currencies, one of them not even American, now predicts US stock market moves more reliably than the American central bank itself. That is how deeply Japan's financial influence has embedded itself into the global economy. The Bank of Japan held its rate at 0.75% at its March 19th meeting, the highest level since 1995. Bank of Japan, March 2026, but the vote was 8-1. One board member dissented, calling for an immediate hike to 1%. The next move higher is not a question of whether. It is a question of when. Most economists expect the next hike in October 2026, but accelerating oil-driven inflation could pull that forward to June. Major Wall Street banks see Japan's rate reaching 1.5% by end of 2027. Morgan Stanley Research, 2026. So what does an orderly unwind look like? And what does a disorderly one look like? The difference is between a managed correction and the largest market shock since 2008. Stay with me, because the 3 variables that will determine which path we take are already moving. And one of them just changed this week. There are 2 ways the yen carry trade unwinds. One is manageable. One is not. Scenario 1. The orderly unwind. The Bank of Japan raises rates slowly. Clear communication. No surprises. One measured hike per quarter. Hedge funds reduce their yen positions over months, not days. American bond yields rise slowly. Mortgage rates inch upward. Stock markets correct, but do not crash. This requires perfect coordination between the Bank of Japan and the government. No external shocks. No political statements that spook traders. With a war in the Middle East, a prime minister demanding cheap money, and $2 trillion in leverage positions, perfect conditions are not guaranteed. If it plays out, global markets absorb the pain slowly. The economy slows, but does not break. Probability, possible but fragile. Scenario 2. The disorderly unwind. A single unexpected shock triggers rapid yen appreciation. An oil spike. An emergency rate decision. A political statement that contradicts the Bank of Japan. Hedge funds holding $2 trillion in yen-funded positions face immediate margin calls. They sell American assets to repay yen loans. Stocks fall. Bond yields spike. Mortgage rates jump within weeks. The Federal Reserve faces an impossible choice: raise rates to defend the dollar and trigger a recession, or cut rates to support markets and reignite inflation. We have already seen a preview of this. In August 2024, one unexpected BOJ hike dropped the Nikkei 12% in a single session and the S&P 500 6% in 3 days. That was with a smaller carry trade. That was without a Middle East war driving oil inflation. That was without a prime minister openly pressuring the central bank to hold rates down. The conditions in 2026 are more dangerous on every single dimension. A disorderly unwind does not stay in Japan. It does not stay in Asia. It arrives everywhere at once. In stock portfolios, mortgage statements, business loan rates, and retirement accounts across every developed economy on Earth. Probability: lower than scenario 1, but rising fast. Watch 3 numbers. First, US dollar to Japanese yen. A move below 145 signals carry trade stress. A sustained break below 140 signals crisis conditions. Second, Japan's 10-year yield, currently at 2.3% and rising. A break above 2.5% triggers global repricing. Third, BOJ meeting dates. April 27th and 28th is next. June is increasingly live. These 3 numbers will tell you more than any financial news headline, because the markets price the reality before the journalists write about it. Japan does not need aircraft carriers. It does not need nuclear weapons. It does not need to declare war on anyone. It holds $1.225 trillion of U.S. government debt. It sits at the center of $2 trillion in global derivatives. And it is raising interest rates for the first time in nearly 2 decades, in the middle of a Middle East war, pushing its inflation higher faster than planned. The 9 people in that Tokyo boardroom are not trying to crash the global economy. They're trying to exit 30 years of emergency policy without triggering the emergency they're trying to end. That is one of the most difficult economic transitions any central bank has ever attempted. And the entire world is sitting on top of it without fully realizing it. The Yin Carry Trade has been the hidden fuel of the global bull market for a generation. When it unwinds, and it is already unwinding, the question is not whether global markets feel it. The question is whether Tokyo can make it slow enough for the rest of the world to absorb. Watch Tokyo, because right now, nothing else matters more. If you want to understand the economics behind the headlines, subscribe to the Econaut. The link is below.